For many, not paying back the mortgage early if they can seems to be a worst advice ever. However, I strongly believe that during times where money is cheap, that is historically low interest rates and higher inflation, investors or individuals are better off not paying their mortgage early. It is actually simple maths, and to understand this maths, one needs to know only three things: inflation, interest rates, and taxes. What is inflation? Inflation is when the unit value of a currency decreases over time. In other words, when the same amount of money falls short to buy the product or service that could have been bought earlier. Most common way of measuring inflation is using Consumer Price Index. Consumer Price Index is a measure of prices of basic consumer goods like transportation, food, clothing, medical, etc. By observing the change in the value of Consumer Price Index, one can calculate inflation. Therefore, when someone says inflation is 5%, it means the unit value of a currency is reduced by 5%, or the consumer needs 5% more money to buy the same product. For example, if one can buy 5 kgs of apples for $10 in 2020, with inflation being 5% per annum, one will need $10.50 to buy the same 5 kgs of apple in 2021. Which means the unit value of a currency is reducing automatically with time without you doing anything. As a result of which, if someone took a mortgage of $100,000 today, then the value of the mortgage will be less after 10 years as compared to today due to inflation. Let's check the value of $100,000 mortgage in future, that is after 10 years, assuming an inflation of 5%. The value of the mortgage will be reduced to approximately $61,000. Obviously, the amount of money that is $100,000 is not reduced. It's the value of that amount that has been reduced without you lifting a finger. Well, we have now established how inflation changes the value of money over time. Let us understand the relationship between interest rates and inflation. Banks or lenders charges interest while lending money to someone. In order for lender to make profit or to increase the value of its loan amount, the interest rate lender charges should be more than inflation. I mean, if interest rate is less than inflation, then only the amount of money lender will have by the end of loan term is more. However, the value of that amount will be less as compared to the original loan amount. For example, bank charges an interest rate of 2% on 100,000 mortgage for 10 years, then the bank will have 121,000 by the end of 10 years, which means the amount of money that bank has is increased. However, the value of the initial amount has reduced because of inflation. As you can see here, to be able to have the same buying power or to maintain the value of the money after 10 years, bank needed at least 162,000 by the end of the loan term. However, bank received 121,000 only. This is the reason why it is in favor of the investors to delay the mortgage repayment or repay the mortgage as slow as possible. To make it simple, if interest rate is less than inflation, repaying mortgage as slow as possible is more beneficial to an investor. Investor is better off using that extra mortgage repayment money to invest in an instrument that returns more than the inflation. Not even that, if an investor can get a return more than the interest rate of the mortgage, then the investor would benefit more by investing that extra money rather than using it to pay back the mortgage early. Let's add the third factor to our equation to support the case of why repaying mortgage early is not beneficial for an investor. As we all know, a real estate investor can deduct the interest paid from his taxable income, which means more interest an investor pays, more he can deduct from his earnings while filing tax. On the other hand, if the investor pays extra amount in order to pay back mortgage early, it will reduce the amount of interest paid and hence the tax benefits. Continuing with our previous example, if an investor does not pay back mortgage early, then the total interest paid in 10 years will be 21,000. That is 121,000 minus 100,000. Now let's assume investor earned $50,000 gross from the property as rental income in 10 years. If the investor have to pay 35% tax on his earnings, then the total tax paid over a time period of 10 years will be $17,500. But wait, we can deduct the interest paid from our earnings while calculating the taxes. Therefore, total tax paid after deducting the interest will be $10,000. As a result, investor just saved $7,500 in taxes. One can also try to understand it by looking at it other way. That is, the losses an investor will incur if he repays the mortgage early. The losses he will incur are loss in return from another investment, loss in tax benefits, and moreover, investor didn't enjoy the benefits of inflation. Therefore, if inflation is more than the borrowing rate and an investor can get a return better than the borrowing rate by investing elsewhere, then he should consider repaying mortgage as slowly as possible. Please note the case I made just now is valid if the inflation is more than the borrowing rate. If that is not the case, then investor should consider paying back mortgage early.